Let's look at selling puts compared to put verticals side by side, and we can see the differences again. So in this case, we're going to be selling the 1255 put, and you can see obviously our max profit is going to be huge because it's by itself, it's a naked option. But our loss is this big, what we labeled undefined number. Remember, it's always defined for selling a put because the stock can only go to zero, even though realistically it's not going to go to zero in 50 days. But our undefined loss potential means we have a high POP. So again, it plays out. Undefined loss, we can lose a lot more than we can make when we sell a put, and because of that our POP always has to be high. In this case it's about 62%. So how about if we sell a put vertical instead? Well, obviously the max profit is going to be a lot less, but the loss now becomes defined. And that's all we care about with selling put verticals, is defining our risk. We know how much we can lose, which is a much better feeling when you go to sleep at night, knowing I can lose $190 as opposed to $119,000. And as traders, that's the most important thing to us. We want to have a defined risk trade. Now in this particular example, our POP is 48% because we can make a lot more than we can lose, but that's not the point of this slide, because these are not the rules we're going to use to trade verticals down the line. The point is just merely to compare that we're defining our risk now. Instead of this undefined risk, we have defined risk on the vertical side. That is the most important thing to us. We'll see in a second how to raise our POP to a better number, but once again, all we're trying to do here is define verticals, and when we define verticals and how to use them, we do that because we define our risk, and that is the key to verticals.